Hey everyone, so my name is Zach Vines, and what I want to talk about is just a brief overview on how to distinguish between variable costs and fixed costs. So as you're beginning your managerial accounting classes, and we're talking about just various expenses that we might be aware of, like utilities expense, just like, what we pay to keep the lights on, what we pay our employees, what we pay to get the inventory in the door, the actual cost of that inventory and everything. Kind of segmenting those are all expenses that we're used to, but you can isolate those expenses down into different categories known as variable costs and fixed costs. So essentially, variable costs, those are costs that are variable in total, meaning that as we continue to produce more, as we continue to sell more and just operate as a business, those variable costs increase and decrease with the increases and decreases in our business. So for instance, if I pay $5 in direct materials, like the raw materials I use to produce a product, if I pay $5 in materials for every unit I produce, then $5 of variable cost per unit times the number of units I produce gives me my total variable cost. So if I have $5 a unit and I produce 10, I spend $50, and those are my total variable costs. So as I produce more and more, my total variable costs grow and grow, hence why they're called varied. So note that they're varied in total. In just a little bit, we'll kind of distinguish between what that is versus a per unit basis, but variable costs are variable in total, whereas fixed costs are fixed in total, meaning that it's a set amount you're going to pay regardless of your output. So the example I gave is, let's say for my business, I have to pay $5,000 in rent a month to be in the facility that I'm in. So I could sell 100,000 units and have the best time of my life, like the business is going great, but I'm still paying $5,000 in rent regardless of that. Where if I don't sell anything and I'm just doing terrible, that $5,000 doesn't go down with it. So this even kind of touches on ideas as far as how you want to structure your business, where the more fixed cost you have, it's kind of high risk, high reward in the sense that, yes, if your fixed costs are high, you have to generate even more sales to overcome those fixed costs. But the good news is those fixed costs don't continue to increase along with your sales, so you have a bigger margin. Whereas with variable costs, if you have a bad quarter or a bad month or whatever the case may be, then the variable costs are only based on your level of output and your level of sales. So the good news is you may not have huge sales, but your costs aren't that high either because they went up and down along with it. That's sort of another story, but this is kind of explaining overall variable costs in total versus fixed costs in total. So let's talk about how variable and fixed costs are on a per unit basis to summarize everything. All right, so what we just talked about is the nature of fixed costs and variable costs at the total level, at the total cost level. Essentially, the namesake of fixed and variable costs has to do with the total level, where fixed costs are fixed in total and variable costs are variable in total. It's the exact opposite whenever we're dealing with a per unit basis, and here's why. So when we're dealing with a fixed cost, those are actually variable on a per unit basis. So what we mean by that is, let's talk about the same example we just said with the $5,000 in rent. That $5,000 in rent can be allocated to specific units because it's still a cost we're incurring, but it's not something that's directly traceable to a particular unit. It's not like me creating this unit of product used up a certain dollar of rent. It's essentially we have some base that we're allocating on some rate, and in this case, we're just doing it on a per unit basis. So we can call that overhead in this situation where it's just general costs that we can't allocate to specific units, but we still are going to do it on some sort of basis. So that $5,000 in rent can be allocated to the unit. So we're turning it onto a per unit basis. So that $5,000 in rent, let's say I produce or sell 5,000 units. In that case, I would allocate $1 to every unit, just the $5,000 divided by the 5,000 units. So it's $1 per unit there. But if my output changes, so instead I have 50,000 units, then the $5,000 divided by the 50,000 units is going to be 10 cents per unit. So you can see, even though the total amount of that rent is fixed in total, when you break it down on a per unit basis, it changes the per unit. It's variable per unit. On the other hand, when we're dealing with variable costs, those are fixed per unit. So the previous example we were talking about before, where we had $5 a unit in direct materials. So for me to manufacture this product, I spend $5 of the direct raw materials it takes to create it. That $5 a unit is the amount I pay for those materials for every single unit, period. It's fixed. That's the amount I have to pay for each unit. It's just that when I apply that on the number of units that I create, it turns into a variable total cost. So long story short, don't want to make this too long, is that fixed cost and variable cost, their namesake is based on the total fixed and variable costs, where fixed costs are fixed in total, variable costs are variable in total. Where we're dealing with a per unit basis is the exact opposite, where fixed costs are variable per unit and variable costs are fixed per unit. So thank you for watching, and I hope that helped.